It's a global banking earthquake. In the US, several regional banks have to be liquidated, and Credit Suisse, one of the largest banks in the world, could only be saved with the help of $1 billion package. What's going on? Is this the 2008 banking crisis all over again? It started with Silicon Valley Bank in the US. As more and more customers began to withdraw funds, the bank plunged into chaos. Shortly thereafter, something similar happened at Signature and First Republic Bank. One reason, the banks had invested customer funds in long-term US government bonds, a traditionally safe bet. But after the Federal Reserve raised interest rates, these bonds lost market value. An increasing number of customers got nervous and withdrew their funds from the bank. This forced banks to sell off some of the government bonds at a considerable loss to get more cash. This created a vicious circle. When the losses could no longer be absorbed, small banks got into trouble. But the US banking system as a whole remained stable.
Small banks you can let fail. If they don't perform, if they have difficulties, they're simply closed down and investors lose money. So investors themselves have an important regulatory and supervisory function to make sure their own bank is doing the right thing. For big banks, this is different.
Just a few days later in Switzerland, a model of budgetary management and finance, Credit Suisse was on the brink of collapse. It had been one of the 30 systemically important banks in the world. At the government's insistence, UBS, another Swiss bank, took over Credit Suisse, as the crisis threatened to pull down the international banking system along with it. The year before, customers had already withdrawn the equivalent of 111 billion euros in assets from Credit Suisse. This was on top of additional losses caused by investment banking and the years of mismanagement.
The cause is not the confidence. That might be the trigger of the crisis at Credit Suisse. The cause lies in the balance sheet and the decisions by Credit Suisse over the past 10 years.
But haven't enough safeguards been put in place since the last financial crisis to prevent the collapse of major banks? And what were they? The European Central Bank controls the banks within the Eurozone, along with each country's financial supervisory authorities. Every year, they examine how the banks manage the lending and investment of customer funds. The banks must remain solvent, even if higher cash outflows occur. And they have to hold back cash reserves of 100,000 euros per customer as deposit insurance. Additionally, the banks need an equity ratio of 10.5 to 13% to ensure they can settle their liabilities at any time. And the so-called banking decree, every institution must be able to demonstrate how specific business areas or the entire bank can be wound down without burdening the taxpayer. Authorities can issue and withdraw banking licenses or impose sanctions based on how banks adhere to these regulations. All this is meant to prevent a repeat of the 2008 banking crisis. But unlike then, we are dealing with high inflation today. Central banks, including the European Central Bank, are being forced to raise interest rates to fight inflation. This has reinvigorated the lending business of many banks. But if one gets into trouble, it can no longer access cheap money from the ECB.
In the 2007-2009 crisis, markets and experts got used to this idea that central banks are really doing whatever it takes to also help the financial system. The biggest difference between then and now is that we're having an inflation issue, and that central banks are no longer able to play this unconditional lender of last resort for everything.
It still seems as if another global banking crisis can be avoided.